Artificially low interest rates over the last 40 years have been an enormous subsidy to people like me who didn't need it, at the expense of working people who prudently saved for their retirement and found that the capital that they saved as a consequence of artificially low interest rates and inflation was insufficient to serve them in retirement. Artificially low interest rates stole from savers and subsidized spenders and subsidized investors. So for all of you who saved blindly, believing in lower interest rates, thank you for what you did for my net worth.
Inflation is silently eroding your savings, with the real rate of purchasing power deterioration at a shocking 7.5%. Rick Rule reveals how the US government, through decades of artificially low interest rates, has orchestrated a massive wealth transfer, benefiting the rich at the expense of everyday savers. Imagine if mortgage rates jumped to 11.5%, leaving many struggling to afford homes. This manipulation isn't just a policy, it's a systematic scam that has drained retirement accounts and enriched those who least need it. In this video, we dive deep into how this financial fraud affects you and what the future holds.
Because I have a banking organization, I talk to a lot of lower level people at the Fed. And I have to say, despite my general anti-government bias, I found I like them, despite myself, that I've had some great conversations. The bias within the Fed as an institution is not to cut rates. The bias of the Fed is that the only institution that stands between us and the rapid deterioration of the US dollar is the Fed. They see no fiscal leadership in Congress. And the institutional bias is not to cut interest rates because they see inflation as a much more persistent problem than Congress does. The top of the Fed is very political. They don't see their customer as the US citizen. They see their customer as Congress. I believe that the real rate of deterioration of purchasing power in US dollars is 7.5%. And I believe that savers deserve a bonus on top of the deterioration of the purchasing power of their savings. So I suspect if the market were left to its own devices, that the interest rate would be 7.5% plus 2 or 2.5%, which is to say 10%. I don't think the market likes that. Now, people want affordable housing, Julia. If you took the price of a first mortgage from its current 7% to 7% plus 2% plus 1.5%, and you had a first mortgage rate at 11.5%, you would have affordable housing. It's just that people want other people's houses to be affordable, not their houses.
Yeah.
I believe in real interest rates. I think the right thing for the Fed to do would be to disband. I don't believe that manipulating interest rates is healthy. Now, manipulating interest rates is very healthy for an old, fat, bald, rich, smart guy like me. When you manipulate interest rates, you steal money from savers. You pay them less than you otherwise would for their savings. And you make those savings available at a discount to people like me who have access to credit and the experience to use it. Artificially low interest rates over the last 40 years have been an enormous subsidy to people like me who didn't need it, at the expense of working people who prudently saved for their retirement and found that the capital that they saved as a consequence of artificially low interest rates and inflation was insufficient to serve them in retirement. Artificially low interest rates stole from savers and subsidized spenders and subsidized investors. So for all of you who saved blindly, believing in lower interest rates, thank you for what you did for my net worth. I don't know. The last time that the Fed gave a treasury auction where there was insufficient attendance was in the Clinton years. They had something called the bond vigilantes.
Yes.
Capital markets now have come to believe in manipulation. We, as investors, insurance company investors, stuff like that, we've learned to leave long bonds to the collective. We've learned to let other people buy that stuff. And we've learned to leave them with the risks while we invested money in instruments that would make money from the debasement of the currency. Whether or not the investor class and the political class will allow markets to work to put the society on a more even footing remains to be seen. The readjustment from fraud to fact would be very difficult for people to get used to. And whether or not we have the will to take the pain while the pain is manageable, or postpone the pain to the point in time where it becomes like the unwinding of the Japanese carry trade, catastrophic, remains to be seen.
With US liabilities growing at a shocking 7% annually, Rick Rule lays bare the grim reality of an impending financial crisis that could decimate your savings. Imagine your purchasing power plummeting by 80%, Social Security benefits being drastically cut, and the retirement age pushed ever higher. Just like the economic turmoil of the 1970s, the $130 trillion in unfunded liabilities is not just a number, it's a ticking time bomb that could shatter the retirement dreams of millions. The truth is, this crisis is fueled by simple arithmetic that too many are choosing to ignore.
Let's assume for a while that the rate in escalation in the price of goods and services continues unabated, meaning that the purchasing power of the US dollar continues to decline at 7.5% compounded. And let's say, too, that we continue to add to the on-balance sheet and off-balance sheet liabilities of the US government, which is to say, we continue to inflate our liabilities by 7% compounded, which is what we're doing now. The accretion in on-balance sheet liabilities, which is to say the bonds, and off-balance sheet liabilities, which is to say entitlements, is increasing at 7% compounded. At some point in time, we have to deal with that. We dealt with it in the 1970s by debasing the purchasing power of the US dollar. That was the first way that we made Social Security affordable. We promised people a certain dollar level of benefit, and we devalued the purchasing power of the dollar by 80% over 10 years. It was a wonderful piece of fraud. We got away with it. And I think we're probably going to do it again. The way that you deal with $100 trillion in unfunded liabilities is you make $100 trillion worth $20 trillion via inflation. I think we do that. What it means is that a bunch of people who hope to maintain their current standard of living with entitlements will find themselves sorely, sorely disappointed. I think that the second thing that we do is that we find the level of services that we've come to expect to be unusually high. And we need to deal with our expectation. As an example, as I said earlier, when Social Security was instituted in the FDR days, Social Security existed to maintain a person at a barely post-poverty level from age 65 on. And the average life expectancy of an American male was 66 years. The average life expectancy of an American female was 68 years. These were affordable insurance programs. The average life expectancy of an American male now is 82 or 83, an American female 85. We've lowered the qualifying age to 62, and we've included people with disabilities. We need to change our qualification assumptions, which is going to be very hard on people who expect to receive a benefit that there is no money there to pay for. So we will at once raise the retirement age. We will reduce the benefits, and we will inflate away the net present value that the benefit buys. We will do all of the above. And that adjustment is going to be hard for people who haven't paid attention to the arithmetic. When I say things like this on shows like yours, I get emails from people saying, I have paid into Social Security for 35 years. I've done my bit. I deserve it. They don't realize that the money's been stolen. The money's been wasted. The money's gone to money heaven. A young boy or girl who's been a good boy or girl, and they put their tooth under the pillow and hope for the tooth fairy, is always disappointed to learn that there is no tooth fairy. And people who believe that our society is going to be able to afford $130 trillion in recourse liabilities, which is increasing by 6 or 7.5% compounded. People who believe that to be mathematically sound need to review what happened last week. Last week is a logical consequence of not understanding arithmetic.